On May 3rd, GameStop offered to buy eBay for $55.5 billion. GameStop's market cap is $11.9 billion. It's a minnow trying to eat the whale, and the deeper you read into the filings, the more interesting the math gets.
GameStop made a non-binding offer of $125 per share, half cash and half GameStop stock, for 100% of eBay common stock. That's $55.5 billion in aggregate equity value, a 46% premium to eBay's closing price on February 4th, the day GameStop quietly began building its position. Today, GameStop holds a 5% economic stake in eBay through a combination of common stock and derivatives. The company is filing a Schedule 13D and an HSR notification with regulators. The offer letter went directly to Paul Pressler, eBay's chairman, with copies to CEO Jamie Iannone and General Counsel Samantha Wellington. eBay's board has acknowledged it received the proposal, said it had no prior contact with GameStop, and committed only to review the offer, with shareholder value in mind. To understand why GameStop thinks it can pull this off, you need to understand the man making the bid. Ryan Cohen is a 39-year-old Canadian entrepreneur from Montreal who never finished college. In 2011, he co-founded an online pet supplies company called Chewy. 6 years later, he sold it to PetSmart for $3.35 billion. At the time, the largest e-commerce acquisition in history. Cohen showed up at GameStop in January 2021, joining the board after building a 13% stake. That same month, retail traders on Reddit's Wall Street Bets forum sent GameStop stock from $20 to over $400 in 2 weeks, briefly making Cohen the most famous activist investor on the internet. The press started calling him the Meme King. He took over as CEO in September 2023. Since then, the GameStop turnaround has been quieter and a lot more boring. The company went from a $381 million net loss in 2021 to $418 million in profit in 2025. SG&A is down about $800 million, a 47% cut. The salaried workforce shrank from 11,000 people to 6,500. The company retired its legacy debt and raised $4.2 billion in long-term debt at 0% interest, a financing structure most companies would kill for. Cohen owns roughly 9% of GameStop. He takes no salary, no cash bonuses, and no golden parachute. His pay comes entirely from stock performance. Back in January, he told CNBC he was planning a transformational acquisition larger than GameStop itself. The eBay bid is what he meant.
Here's the part that makes Wall Street do a double take. As of Friday, May 1st, GameStop's market capitalization was $11.9 billion. eBay's was $46.2 billion. GameStop is offering to acquire a company nearly 4 times its own size. When the news broke Monday, the market voted with its feet. eBay shares climbed about 5%, settling near $109, well below the $125 offer. GameStop shares dropped roughly 10%. That spread tells you what investors actually think. If they believed the deal would close at $125, eBay would be trading much closer to that number. At $109, the market is essentially pricing in a high probability the bid never gets there. Prediction markets agree. Polymarket users give the deal a 15% chance of closing. Kalshi traders are slightly more generous at around 25%, though volume on that contract has been thin. This brings us to the central problem with a non-binding offer of this size, the financing. GameStop's most recent disclosure puts cash and liquid investments at about $9.4 billion as of January 31st. The company also has a highly confident letter from TD Securities for up to $20 billion in acquisition financing. Emphasis on highly confident, which in M&A language is not a binding commitment, just a bank saying it thinks it could probably arrange the loan. So $9.4 billion plus $20 billion gives you about $29.4 billion of potential committed capital. The cash portion of the offer alone is $27.75 billion, half of $55.5. So on paper, GameStop can technically cover the cash side, but with very little margin. The other $27.75 billion comes in GameStop stock. And remember, GameStop's entire market cap is $11.9 billion. To fund the equity portion, GameStop would need to issue more than 2 times its current market value in new shares, massively diluting existing shareholders. And remember those $4.2 billion in 0% convertible notes we mentioned earlier? Those are bonds that can convert into stock if the holders choose. Layered on top of the dilution from this deal, that's another reason existing GameStop shareholders are nervous about the math. This is the math Andrew Ross Sorkin tried to walk Ryan Cohen through on CNBC's Squawk Box. Cohen, visibly annoyed, declined to engage, telling the host that the details were on the company's website and that GameStop has the ability to issue stock in order to get the deal done. The bull case from GameStop's pitch deck rests on cost-cutting. The company says it can pull $2 billion in annualized expenses out of eBay within 12 months of close. The breakdown: $1.2 billion from sales and marketing, $300 million from product development, and $500 million from general and administrative. The argument GameStop is making is direct. eBay spent $2.4 billion on sales and marketing in fiscal 2025 and only added 1 million net active buyers, going from 134 million to 135 million. That's user growth of less than 0.75% against a marketing budget the size of a mid-cap company. On those cuts alone, GameStop projects eBay's diluted GAAP earnings per share would jump from $4.26 to $7.79 in year one. Operating margins would expand from about 20.5% to 38 to 40%. Worth flagging, those are GameStop's own projections, not independent estimates. The strategic pitch is that GameStop's roughly 1,600 U.S. retail locations could give eBay a physical network for authentication, intake, fulfillment, and live commerce, particularly for collectibles, which now make up 33.1% of GameStop's quarterly sales. Critics aren't sold. Wharton management professor Paul Neri pointed out that eBay's biggest categories, handbags, watches, automotive, sit completely outside GameStop's footprint, and that cross-category cost synergies in unrelated retail rarely produce the savings the pitch decks promise. His back-of-envelope estimate? Best case, GameStop might find $1 to $2 billion in real synergies, not the $2 billion they're projecting from cuts alone, plus the upside from physical store integration. The math GameStop is selling assumes everything goes right. The math the skeptics are running assumes some of it goes wrong. The short version: eBay's board is under no obligation to accept, and there's no indication they will. But Cohen has signaled he's willing to escalate. He told the Wall Street Journal he is prepared to wage a proxy battle and take the offer directly to eBay shareholders if the board refuses to engage. That would mean nominating an alternative slate of directors at eBay's next annual meeting and asking shareholders to vote out the current board in favor of one that will negotiate. It's a long, expensive, public fight, and historically, these are uphill battles even for activists with much larger war chests. Cohen has done a turnaround like this before, at GameStop itself, with the financial results we walked through earlier. He's pitching eBay shareholders the same playbook. Whether it scales to a marketplace 4 times the size of his current company is the question every investor is now trying to answer. Until eBay's board responds formally, prediction markets give it about a 1 in 5 chance. The next move belongs to a boardroom in San Jose. Thanks for watching. Don't forget to like and subscribe, and see you in the next one.